Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, January 3rd, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So this is the first show of 2019. I am not going to go and make some bold predictions. Instead, I'm just going to go with the current signals we have. We've got volatility in full force right now. We're getting some rubber band bounces that could lead to consolidations. I think we should forget about relative performance and focus on absolute performance. We'll look at bonds. We'll look at some uptrends outside the U.S. And finally, I'll finish with FAANG plus a few other high beta stocks. First, I'd like to take this chance to wish everybody a healthy and happy and hopefully prosperous 2019. So if you're watching this show, you know where to find it, but just in case, you can always find On Trend on Tuesdays and Thursdays here on Stock Charts TV, and there's a link at the top of every web page. And when you click on that link, you will be taken, of course, to Stock Charts TV. And if you scroll down there, you can see the schedule. And every Tuesday and every Thursday at 10:30 a.m. is this show. It's repeated again at 11 a.m. and then again throughout the day. There you can see it again at 7:30 p.m. And then once it's past the next day, then you can watch this where it's archived on our YouTube channel by clicking that Watched Past Shows link. And there is the YouTube channel. And if you scroll down, there you can see On Trend there. And there's a video that has an outlook for 2019 as far as what to watch going forward. Looking at the current reality based on the 5-day rate of change. So before we consider trading in the stock market or investing in the stock market, it's important that we understand the current character of the stock market. Okay, what kind of environment are we in? Are we in a trending, low volatility, low risk environment? Or are we in a volatile environment and or a downtrend? And I think right now we are currently in a downtrend and a volatile environment. And that is not the kind of environment, at least I want to be trading in. There are certain traders that do thrive on high volatility and downtrends. I'm not one of those. All right. I think this is an environment where I'd rather be on the sidelines. But I still, watch the market closely. I look at signals, I look at signs, but I'm much, much, much less active. So if we look at this S&P 500 chart at the top, we can see the character of the market basically changed there in mid-October when we had that sharp breakdown and we had a number of breadth indicators turn bearish. And if we look in late January, early February, we had another change in the character of the market. And I'll get to S&P volatility on the next chart, but I just want to show you the 80% indicators and how they've turned over the last few months. So you can see here when we had that initial down thrust in late January, early February, when we had 80% readings going below minus 70%, the market turned volatile in February, March, and April. And we had a number of readings below minus 70% and above plus 70%. And it wasn't until May that the market settled back down and started to move higher again on a steady or consistent basis. So if we look to October here, again, we can see we got the bearish breadth thrust to the downside in October. And then we got some moves above plus 70%, but also moves below minus 70%. And then, of course, we had that big string of negative readings from early December to just before Christmas. And then we had like a plus 90% up day there on the 26th of December. So I don't think that's enough to say we've had a bullish breadth thrust and we're ready to turn bullish on the market again. I think it's just indicative of the volatile environment. Now, this 80% reading for the S&P 500 is in that first window. And then I've got it for the S&P Mid Cap 400, S&P Small Cap 600, and NASDAQ 100. And what I want to show you is look how weak that follow-through bounce was in S&P 600 breadth. Okay, 80% did not get above 50% over the last 4 days. So there wasn't any real follow-through to that big upthrust we had on December 26. And in investors' terms from IBD and William O'Neill, we didn't have a follow-through day. Now, as far as the current market environment, we can see that volatility is increasing. This indicator window down at the bottom is the 5-day rate of change. And you can see over the last 5 days, the S&P is up 6.76%. All right, that is the biggest gain over a 5-day period. Well, there wasn't a bigger gain in 2018. So, yeah, it's the biggest gain in 2019. But what I want to point out here is that period I was talking about from February, March, and April. You can see that 5-day rate of change narrowed. Okay, volatility was subsiding into May, and that's the kind of environment we want when volatility is subsiding. And if we look at volatility now, it's just been on the increase. All right, we were like down 7.5% over a 5-day period in the latter part of December, and all of a sudden we're up 7% at that peak there, or 6.76%. So volatility is increasing, and that's the current environment that we're in. You got to say, well, do I want to be trading in this kind of environment or investing in this kind of environment? And if you do, what kind of adjustments are you going to make? Because you're not trading in a trending environment. It's completely different, this volatile environment that we're in. As far as I'm concerned, this is an environment that we want to be either out of or very low exposure to the stock market, either long or short, because you can see how sharp these reaction rallies in a bigger downtrend can be. So we're currently in the midst of what I would call like a rubber band bounce, and that could lead to a consolidation. So here's a chart of SPY, and you can see that we've got this really sharp decline from the 278 area all the way to 234, and now we've got a big bounce underway. And this is what I would call a rubber band bounce, because you can see the decline was so sharp that it stretched that rubber band and got it way oversold, and then you let go, and the further you've pulled it back, the sharper the counter trend bounce. Now, as far as positions, this is kind of like a no man's land for either longs or shorts. If anything, maybe it's a shorting opportunity because you've had a little bit of a bounce and maybe we're going to head back down. But you can see we're not even short-term overbought as denoted by 5-period RSI. You can see here 5-period RSI became overbought the second week of November roughly, and the first week of December there as the market consolidated. But often what you have is you have these sharp declines, and you need to work off these oversold conditions, and so you get a consolidation. So you get your first rubber band bounce, you get a test, and then you get another bounce within that forms a consolidation after the decline, and then we broke down. So if you apply this logic to what we're seeing right now, then that means we could see a bounce, a pullback, a bounce, and some sort of choppy consolidation unfold in the coming weeks. When we look at the NASDAQ 100 ETF QQQ, we can see that during this February, March, April period, we had higher lows in QQQ. So it was outperforming during this period, and that led to the outperformance that we had from May until September. And then if we look at this October-November period, while SPY was kind of moving flat and, tested this high here in December, QQQ had lower highs and was moving down. So QQQ has been underperforming. Now we're getting some sort of a rubber band bounce, if you will. And my best guess for a resistance area might be this 158, 159 area. We kind of have some lows here that might be support that was broken that turns into resistance. And you can see RSI is yet to make it above 70. So if RSI gets above 70 and you get into this resistance zone, that might be a peak that signals the start of a downtrend or a place where we might find resistance. If you look at MDY, you can see that this one is even further stretched on the downside with an even sharper decline here. So it's getting a rubber band bounce. We'll see if it follows through today because the futures are already down sharply. But, there might be the first resistance level around 320. And small caps kind of look like mid caps in that they just broke down here. And they could rally back to that breakdown point around 75. Now I started with that S&P 500 rate of change chart at the beginning to show you the current market environment. And so everything that goes from here has to be considered within the broad market environment, which is volatile and bearish. And that is like the worst of both worlds. All right. At least you could have a dull downtrend, but no, we have a volatile downtrend. So this makes it incredibly difficult to trade either side. If we look at the retail SPDR XRT, it fell 23% from the middle of November to the end of December. So it could get a rubber band bounce. But again, I don't know how far it's going to continue because the bigger downtrend is the dominant force at work, and it could take over at any time. When we look at semiconductors here, this is XSD. We can see this break zone here that could turn into resistance on any bounce that we get here. But, 17% decline, you're entitled to an oversold bounce. It could fizzle here at 67, or it could fizzle at current levels. Regional banks, they were one of the hardest hit groups recently, especially going back to September when you got that decline from 63 to 44. And then the most recent leg down was 22%. And you can see to recover after a 22% decline, you need a 28% advance. So to get from that low back to this high, we would need a bigger advance. And that is the reason we tried to cut our losses, because you need a bigger advance to make up for a loss. We look at transports. They were hit hard as well, 21.7% decline after that wedge break. FedEx was one of the leaders on that decline. And biotechs. Now, this is one where broken support may turn into resistance. You can see you had the initial decline, and then I labeled this a consolidation within a downtrend, and then we broke down and declined 20%. And now we could rally back to this support break around 100, 101. Now I want to show why it's important to focus on the absolute and not the relative. So even though utilities, healthcare, and staples are holding up better and showing some relative strength, I had to ask myself in mid-December if it was really worth it if you looked at the absolute returns and the actual price charts. Now, as far as I'm concerned, the price chart is pretty much the only thing we need, all right? Unless you're doing scans, you don't even need indicators, and I use indicators pretty sparingly. I only need a handful of indicators. And if I'm comparing to names like healthcare versus the market, I'm going to compare their price charts and their highs and lows. And I'm also going to look at the absolute price chart for XLV and make my decision based on that price chart. Because if you look at the price relative at the bottom, you look at XLV relative to SPY, it had a nice relative uptrend up until November. And of course, you had that big move up from May until September, and then it kind of moved flat. But here we've got a breakdown, a clear breakdown in December. And if you look at the relative trend, it's still pretty flat. It still looks okay. But if you look at the absolute trend, you wouldn't touch this because it's broken down. And so that's why I think we need to concentrate on the price chart first and foremost. If we look at XLP, consumer staples, the relative trend still looks okay. You can see that it's still flat, kind of drifting higher. That's a higher high in December, and it's above that low there in November. So there's a relative uptrend here in XLP relative to SPY. But if you look on the price chart, there's a clear breakdown in mid-December. And so again, that's why we got to focus on the actual price chart and take our decisions there. Finally, when we look at utilities, all right, utilities were holding up and they had a good looking price chart there in the early part of December because they hit a new high there, but then got hit hard and then broke support here with that big decline below those November lows. So utilities are actually unchanged since August. And I pointed that out in December after this decline. You'd been all these months and you didn't have any gains to show in utilities. And you have to ask yourself, looking at the broad market environment, is it worth even owning utilities? And my answer is no when you look at the absolute price chart. And that's what we got to look at, because if you lose in your account, you're not going to say, well, I lost less and I feel better. No, if you lose, you lose. And that's why you've got to look at the absolute numbers. Now we're going to look at Treasury yields versus junk bond yields and global Treasury yields. So I'm here at the FRED website, the economic research site of the Federal Reserve Bank of St. Louis, and I am not going to start getting into economics, but I do watch the spread between junk bond yields and Treasury yields. And you can see here in 2014, they started moving higher, had a little bit of a dip, and then there's a big move higher in 2015 into 2016. And that was not a very good time for the stock market. And if we look at what's happening now, there you can see that breakout in the spread. You can use this slider here to close that and get more granular on what's happening. But you can see that we've clearly had a break to new highs. We're at our highest level since the latter part of somewhere in 2016. And it just continues to move higher over the last few weeks there. So that tells you that bond investors are demanding more and more yield from junk bonds, which have higher risk than treasuries. And that is a negative for the risk environment and possibly for the economic outlook. Now, when we look at junk bonds on the price chart here, we can see that the unadjusted junk bond ETF, HYG, has been declining since the middle part of 2017, and it had its first breakdown really in early 2018. And the indicator window is the PPO 5-200-0, which shows the difference between the 5-day EMA and the 200-day EMA of that junk bond ETF above here in the window. And when it turns negative, that means the 5-day EMA is below the 200-day EMA. And you can see it got a little positive there in September, October, but then started back down again in the middle part of October and is now at its lowest level since early 2016. So this tells you that this is a pretty strong downtrend in junk bonds. And junk bonds are more like stocks, all right? They're more dependent on the economy. One more thing is I've highlighted two periods. This is at 2015, or actually from the middle of 2014 to the early part of 2016, when this 5-day EMA was below the 200-day EMA for the junk bond ETF. And you can see the S&P 500 pretty much went nowhere during this period. And we're in the same situation now, maybe even worse, because the S&P 500 is at a 52-week low, or did hit a 52-week low in December. So not good looking charts here. Briefly, when we look at treasuries, this is a weekly long-term look at treasuries. This is the unadjusted TLT, but we can see breaking above that 40-month moving average there and above that big wedge line and challenging resistance here from those 2018 highs. And then we look at IEF, the 7 to 10 year Treasury bond fund. It broke out of resistance and broke that trend line with a big move up over the last few months. So maybe we're getting overbought with treasuries, but if you get a throwback to that 103 area, that might be an opportunity to partake in a bigger uptrend that seems to be developing for treasury bonds. And then, of course, the inverse of what's happening in the treasury bond market would be treasury yields. And you can see the 10-year yield there at the top has moved back below 2.7%, which is 27 on the chart. So it's at its lowest level since the early part of 2018. And then the 30-year yield has broken that wedge line there and is testing the support zone. But if it breaks down further, that could mean long-term yields are heading back down towards those 2015, 2016 lows. Then if we look at the yield curve, we can see that it is still flattening, but it is not inverted. And I've shown this before. This is the 10-year less the 2-year, and the 10-year is currently 0.16 higher than the 2-year yield. And the yield curve doesn't get negative until this one inverts, I think, or turns negative. Now, the 2-year yield, you can see up at the left-hand corner there, the 5-year yield's at 2.49%, and the 2-year yield's at 2.5%. So the 2-year yield is just above the 5-year yield, which shows an abnormality within the yield curve. But I think more importantly is when you look at global yields, all right, they're all falling. The 10-year yields in the U.S. are moving lower. In the U.K., they're moving lower. In Germany, they're moving lower. In Germany, the 10-year yield is at its lowest point since the fall of 2016. And then in Japan, they're back at zero, the 10-year yield. So this is not good for the outlook for the global economy. So to find any uptrends, we're going to have to go outside the U.S. and outside of the stock market. So to find some uptrends, we're going to have to look outside the U.S. and outside of equities. And I just noted that TLT and IEF seem to be breaking out on R and uptrends. Gold is above its 200-day moving average and showing some strength over the last few months. I'm just not a fan of gold in general. If you look at cocoa here, cocoa is showing some possible breakout potential here because you got this wedge here, and now we're challenging resistance and above that 40-week moving average. And the equivalent for the ETF would be NIB, the cocoa ETF. So it's establishing some support here and trying to turn up. So looking for a breakout there. Palladium continues to remain strong. I don't know what the story is here with palladium, but it continues to hold its trend. It's slowed in recent weeks, but it is still an uptrend there. So that's one place to find an uptrend. Also, outside of the U.S. equity market, we have Indonesia, which is looking positive on the price chart here. First, we got the breakout there with the big surge in November, and then we got a breakout later on when the rest of the world was breaking down. And then if you draw some lines here, it's kind of like a consolidation within an uptrend here. It's kind of like a flag. So Indonesia looks like it is poised to break out of this flag and is one strong spot in a world of weakness. Because, look what happened in the U.S. during this period. October, November, December moved down, and Indonesia moved up. Then we look at the Philippines. They did the same thing. Now, the only negative here is, Philippines index hit a 52-week low there in October. But you can see, here's the S&P moving down, and here's the Philippines moving up, getting a breakout, and then this little triangle and breaking out of that triangle to start the year. So the Philippines is one of the stronger areas. And then Brazil, all right, I highlighted this one at the end of the year. Brazil's got a falling wedge. You can see first the breakout there in September, October, and then the wedge is a correction after the breakout. And then we've got this breakout from the wedge to signal a continuation higher. So Brazil is still looking okay. And finally, ePol, which is the Polish ETF, and they do not have the euro, they have the zloty. And this one has moved higher over the last couple of months, while the S&P 500 and rest of the world have moved lower. Now, Poland still hasn't quite reversed the downtrend, but it looks like a massive advance, and perhaps this is a correction. You can see it's probably about 50%, and you found support near those spring-summer lows. So watch for an upturn here in Poland because it is holding up better. And now we'll look at the FAANG stocks plus 4 others. So nothing is immune to selling pressure, and the case in point is Apple, which hit a 52-week low in the latter part of December with that late decline there. You can see that that low is below this low. On the indicator or on the chart, I've got the price channel, the 255-day price channel, which is the pink line. So that's a 255-day high, and that's a 255-day low, and it broke that low. But you can see Apple had already broken down because you had a support break here. The broad market environment was already bearish, and this was like a consolidation, and then you broke that consolidation, and then you broke the 200-day. So we had a number of signals along the way for Apple. Sure, nobody can predict the steepness of a decline, but the signals that told you this trend was reversing were clearly there for Apple. Look at Amazon. It is working its way lower. It's clearly not as weak as Apple, but you can see, after the initial decline and breakdown, you've got this kind of consolidation here, and then we broke the consolidation. We're rallying back, but Amazon doesn't get any kudos unless it can break back above 1800 here. So it's in a downtrend and contributing to broad market weakness. We look at Facebook, all right? This is nothing but an ugly chart, and it has been an ugly chart since this big gap down in July, which it never recovered from. And after that gap, it was just lower low and lower high as it moved to a 52-week low back in October. So the market was starting its breakdown in October, and Facebook was already at a 52-week low. Now, could Facebook bounce back to the 150, 155 area? Sure, but is it in an uptrend? Is it a stock I would want to own? No, it's not at this stage. Google is holding up a little bit better recently. Now, what's interesting about Google is here's that October low, and the November low is just below it. And you can see we broke it again in late December, but snapped back. So, Google's showing a little bit of strength by holding that October low and getting back above it. And you can see these lows going back to December 2017, February, March. So there's a lot of psychological support or even buying support at that 1,000 area, because you can see that buying came in a number of times at this 1,000 area. I mean, this is the best example of support I've seen in a long time. So, Google's one to watch as it toys with this 1,000 area. Intel looked like it wanted to break out of this channel here with that big move up above the 200-day at 50, but it fell back down, so it does not look good at this point. We look at Microsoft. It was holding up a lot better above its 200-day, but even it succumbed to selling pressure with a break below the 200-day in December. It's still holding up a little better. Netflix peaked well before the market and remains in a downtrend with the 50-day below the 200-day. NVIDIA had the biggest decline of all with the move from 290 to 130, more than 50% down, new 52-week low. And Tesla is kind of interesting because, it held up during the decline in November, but it got a breakdown, it looked like, in December and opened with a gap down here in January. So it could be heading to test those lows there. And that concludes this edition of On Trend. Thanks very much for tuning in. And remember to stay on the right side of the trend. Have a great day.